Charles Schwab, Citizens Financial, and US Bancorp are among the top trending tickers on Yahoo Finance this morning. The regional banks out with mixed quarterly results as they wrap up what has been a tumultuous year for the industry. The big decliner of the morning is Charles Schwab. Now that stock having its worst day since March after reporting net new assets fell nearly 50% on the year. That fell short of the street's expectations. You're looking at a drop of nearly 7%. Joining us now is Nathan Stovall. He's S&P Global Market Intelligence Director of Financial Institutions Research. Nathan, it's great to have you. So a lot to unpack here. Let's first start with the results that we're getting out from Charles Schwab. Again, pressure on the stock off nearly 7% in early trading. Certainly has been a very challenging year for the industry. Is the worst behind Schwab and some of its competitors?
Well, I think it's just a continued grind. I don't know if we've seen anything necessarily that surprising out of this quarterly results. We've seen continued pressure on deposits, continued pressure on liquidity, and really a reminder that higher for longer rate environment is here. We'd seen a big pop for the entire group as the prospect of more rate cuts from the Fed coming in the second half of 24 was getting higher up on the table. And as we just heard from one of the last guests, that now that the market is maybe backing off of that a little bit, moving away from that 6 to 7 cuts, maybe closer to 3 or 4. And that's what we kind of assumed in our forecast. And I think that's what you're seeing is you're seeing continued pressure on funding costs across the board. That's very much what we expected. And seeing banks defend their deposits with higher rates, and think that continues to play out. So some of this, I think, is just a little bit of the market getting a little bit ahead of itself in terms of the expectation of a Fed pivot and maybe hoping that some of that pressure would subside. But pretty decent results, I think, from most across the board, albeit with some headwinds on the funding side and slower loan growth. But nothing really terribly worrying from the credit side, which is a big marker for the street right now as well.
Nathan, on aggregates, the provisions for loan losses or credit losses, that's certainly come up a few times at this point during the early moments of the earnings season, especially as we focus in on banks. Big banks last week, regional banks this week. How does that have perhaps a more profound impact on some of the regional banks, though?
Sure. I mean, that's the area that is really in focus. The street has been very concerned about their exposure to commercial real estate in particular. But thus far, we really haven't seen anything that would look any different than call it normalization in credit trends. Because remember, the group's really been over-earning on credit. And what I mean by that is they've had very little loss content in form of charge-off activity, and provisions have been historically low. And you're seeing both come up, but come off of such low basis. And we haven't really heard anybody say anything that is really worrying. They're still in that normalization camp, moving back towards, call it, pre-pandemic levels. The consumer remains resilient, and the CRE piece is definitely one that we're watching really closely, but it's going to take a while. It's not going to be 1 quarter, even 2 quarters. It's going to be sort of a multi-year shift, and I think the street still hasn't quite fully appreciated that, particularly when you look at the regionals. The other thing I would say, too, when you look at their exposures, you need to have a little bit more nuance in assuming that everything is an office skyscraper. They might be some specific different subcategories within that asset class that will perform way differently. And you even have some stuff that might even be office loans that a regional holds that has nothing to do about a return to work conversation. If you're talking about local medical, like a dentist's office or even a doctor's office.
Nathan, as we move past some of the current challenges, some of the current headwinds in the market, and as we look further ahead down the road, there is, of course, what the impact is going to be on some of the higher credit costs and the impact that is going to have specifically on some of these regional plays. What is that going to look like in terms of the pressure that we could see on earnings? And are some of these banks going to be able to weather what could be a pretty tumultuous couple of quarters there for them?
Sure. And we do have that expectation that you're going to see notably higher credit costs, both in the form of higher charge-off activity and banks continuing to build reserves. But we think it's a manageable hit broadly. And it's a headwind to earnings. And so it's really an earnings discussion rather than a safety and soundness discussion for the vast majority of institutions. I think you might have some outliers there, that could absolutely happen. And you'll have some that don't perform as well. But broadly speaking, we think this is more akin to a modest downturn than anything really severe. And it will just play out over time. The other thing I would say is when you look at the valuations of the sector, yes, they've ripped up in December off of the lows that we saw earlier in 23. but they're still historically cheap relative to the S&P 500. So some of that deterioration, you could say, is already baked into the valuation.
Nathan, we got to go, but just with the 15 seconds that we have left, we've got most recently out of the Consumer Financial Protection Bureau, a plan that's been proposed to curb overdraft fees from banks. What's the read through to the regional banks as we've been discussing, or perhaps even more so to some of the big banks as the administration sounds keen to go after this?
Sure. Well, I mean, that's a hit to earnings. They make money on fees due to overdraft fees, and the CFPB has been pretty clear that they're going to be firmly focused on going after that and trying to curb that. And I put that in the camp of what we think is much more intense regulatory enforcement post liquidity crunch in March. And all that serves as a headwind for earnings. I think it's modest. It's something that the banks will be able to digest, but it is going to be a headwind, and I don't think it's going to go away. That might feel like a long time ago, what we saw in March of 23, but the CFPB in particular is laser focused on curbing those fees. But I think regulators broadly want to make sure that banks are liquid, safe, and sound, and we think they are, but that'll lead into their earnings modestly.
Nathan, always a pleasure to get some of your insights on the sector. Nathan Stovall, who is the S&P Global Market Intelligence Director of Financial Institutions Research. Thanks so much.
Thank you.